European regulation is full of jargon and acronyms. You might have heard about UCITS, IFMD, MiFID, and you might have also heard about ELTIF. ELTIF stands for European Long-Term Investment Funds. The ELTIFs were the darling of the Capital Markets Union because with the ELTIF, Europe planned to give retail investors exposure to long-term investment strategies that before were available only to the more sophisticated investors. The first iteration of ELTIF regulation wasn't as successful as European authorities intended it to be, and that is for various reasons. In this video I wanted to discuss the changes, or some of the most important changes that are taking place with ELTIF II, and as a bonus also look at how American managers could benefit from launching an ELTIF. In 2015, when the ELTIF regulation was launched for the first time, we were already hearing sparingly here and there about this phenomenon of retailization of private markets. But we believe that at the time this phenomenon was concentrated only in certain pockets of Europe. It is not as spread or accepted and understood as it might be. And this is confirmed by the fact that at inception, very few ELTIFs were launched in the first, let's say, 5 to 6 years of the regulation being in place. And ELTIFs were also launched in European domiciles where you wouldn't really traditionally set up a fund unless it's for that specific market. We are talking about ELTIF launched out of Italy or France, which aren't the European domiciles where you would launch a fund that has more pan-European ambitions for distribution. Which means that the retailization of private markets was a phenomenon that started in this part of continental Southern Europe at the beginning and to start with. What is changing with ELTIF II? The European Commission did identify some supply and demand constraints. And so basically we believe that the demand constraint was more in taste of retail investors, which wasn't as evolved at the time to understand these investments in long-term investment opportunities. But the European Commission, in a report, found out that basically there were some issues with existing provisions when approaching retail investors. And so with ELTIF II, some of these provisions have been removed. We are talking about the additional suitability assessment that needed to be carried out on investors wanting to purchase ELTIFs. And that was clearly redundant because MiFID is applicable in these scenarios and it already provides for this type of assessment. So it was an additional burden on ELTIF managers, which traditionally are alternative investment fund managers who don't want to deal with retail investors at all, and so it was problematic to pass this additional responsibility to local distributor. The second issue was related to the limits of investments, and that was the case of investors that didn't have in excess of 500,000 euros in their portfolio, and they were limited to an initial investment of 10,000 euros, capped then again at 10% of their existing portfolio. The upside in terms of protection of these thresholds and limits was very difficult to measure, and so these are gone as well as part of the second level regulation. For what concerns the constraints on the supply side, ESMA in another report made it clear that even though the ELTIF is a product that is born for retail investors, we know that also professional investors might want to invest invest in this type of product, and the needs and the expectation in terms both of protection but also of investment horizons of these two type of investors is too different to be able to find one only set of rules to accommodate it all. And so it left to the European authorities to find a solution to this conundrum. And so this brings us to one of the other main changes with ELTIF II, which is a clear-cut distinction between ELTIFs for professional investors and for retail investors. This will have also a sort of a visual impact because ESMA holds a register of ELTIFs and will add an additional column or category to say whether an ELTIF is allowed for professional investors marketing only or also retail. Main differences are in terms of the portfolio composition and diversification and also concentration, right? So when an ELTIF is for professional investors, all the thresholds of the 20% of the portfolio investable in one single underlying investment opportunity or fund, as well as the concentration limit of not investing more than 30% of, for instance, the shares issued by an underlying fund. Those limits are existing only in the case of ELTIF for retail investors, but not for professional investors ELTIF. There is one more element to consider for what concerns the disclosure, and it is the fact that when the ELTIF is for professional investors only, likely you will not need to produce a PRIIPs kit like it's the case and it's the case already today for the ELTIFs for retail investors. One of the most debated questions on ELTIF was related to the localization of the underlying investments of ELTIFs. As we said, ELTIFs are born under the Capital Markets Union, and so were a tool to support the financing of small, medium enterprises, infrastructure projects in Europe, and that might have been a constraint to the supply of ELTIFs. So the idea is that in the ELTIF II we drop the qualification of European for these investments, and there is opening to investments that are located in third countries, that are generating revenue or profit in third countries. And this is something interesting because on the one hand we alter a little bit the initial proposition, which is to have a tool to support exclusively Europe, but at the same time we support Europe through the ELTIFs in an indirect way because it's still an alternative investment funds, which has to be European, which has to be managed by a European AIFM, and which will create an index that will support the European economy in the same way. I wanted to look now at one of the other changes in perception this time towards long-term investments that will potentially help the growing of this sector, and it relates to liquidity. As we know, ELTIF are traditionally investing in illiquid opportunities, and so there has to be an understanding, which now seems to be there, that basically investments cannot be redeemed with the same frequency that can happen for a public market fund, if you like. And so the idea is that there is now a way to allocate to long-term investment opportunities through pensions, for instance, right? And this was one of the acquis from the first iteration of the ELTIF. And this is what will help perception, because basically there is no expectation to redeem pensions from a day to the next. But at the same time, the ELTIF II regulation is opening to the possibility of having a secondary market. And here we see that there should be more energy concentrated on creating a secondary market for these opportunities, because that is also what happens in the capital markets in the US, which Europe is looking at as a model. And so basically in the US there are for sure stock exchanges for long-term opportunities where you can redeem for 80 cents on the dollar, 90 cents, a longer-term investment opportunities in case you have to cash out earlier. And the same should be done also in Europe. Lastly, what is in store for American fund managers who want to consider an ELTIF? We believe that opening the geographical scope of the underlying investments to third countries other than Europe might make this proposition more interesting for American managers. In fact, we did receive over time always the same question: what can we invest in if we are American fund managers and we want to launch an ELTIF? And the answer was something that is European-centric. Of course, opening to infrastructure projects and other projects that are neighboring Europe is a big plus and might ease the supply constraint. However, we need to consider that there always have to be a link with Europe. Europe will always have to benefit from these projects, which cannot be completely divorced from Europe. The ELTIF is not going to become a vehicle to funnel the growth of necessarily other countries where Europe is not benefiting at all from this endeavor. So just to make an example, so if you plan to launch an ELTIF in Europe to then fund the creation of a solar plant in Texas where there is no advantage for Europe, that is likely something that will not be acceptable. There is more to come on European regulation. As always, thank you very much for watching and stay tuned.